Hello, friends. Welcome. Good afternoon. Our topic today is interest rate movement and how it impacts the fixed income products and our investments in debt mutual funds. Our thought leader on this topic is Mr. Joydeep Sen, a well-known name in the financial circles and media, especially when we wish to have some deep understanding on fixed income. Joydeep is a CFP professional since 2010, almost 12 years. He has been contributing to financial services for over 30 years now, 25 years in various corporates. His largest stint was with BNP Paribas for 13 years in its wealth management segment. Over the last 5 years, we have seen Joydeep evolve in his own capacity as a faculty, author, and columnist. Joydeep is a visiting faculty at SBM and MIIMS. Additionally, he has conducted training for many a corporate. Joydeep has authored 4 books, his mainstay in these being fixed income, apart from financial planning and wealth management. He has contributed close to 400 articles in various publications. He is a regular face on CNBC Mutual Fund Show. In 2019, BFSI Congress reckoned Joydeep Sen amongst 100 most influential BFSI leaders. And most recently, in November 2021, he has been awarded by the Financial Services Marketing Summit as 50 most influential financial services marketing professionals. Welcome, Joydeep.
Thank you, Pushkar, and thank you for the wonderful introduction.
Joydeep, it's great to have you on this webinar today.
Sure.
Fixed income is a pretty misunderstood topic, and it's complicated also because we have seen in various countries a larger volume goes into fixed income as compared to equities, probably in India as well. Joydeep, when we think about investments, I think equity comes on top of our mind. I think many people who are young investors, they just open their account and DIY, they invest in equities. But when it comes to fixed income, I think there's a lack of understanding. Though, Joydeep, we get traded every day because when we have our funds in savings bank account, in fixed deposits, we get traded every day in fixed income markets. So why is this lack of awareness in fixed income securities?
Yeah, that's a very relevant question, Pushkar. There are 2 reasons for this. One is equity is more exciting, and that is not so exciting, and it is kind of dull. And also, if you look at returns over a long horizon, equity has provided higher return. So if you look at horizons like, say, 10, 20, 30, 40 years, equity has given higher returns. So people get attracted by the higher returns, and of course, the excitement, the volatility that enthuses people. And from that perspective, that is kind of a old man's thing. As you said, it does not really attract the young crowd as of today. Okay, so should I start sharing my PPT?
Yes, Joydeep, one little
Sure.
question.
Sure.
As you said that equities have better return than fixed income. So naturally, equities have higher risk. So is the fixed income also a low risk product by nature, as the interest rate movements happen, like nowadays interest rates are going up. So they impact fixed income more than equity markets. I think there's a misconception that, okay, fixed income means, okay, it's riskless and risk-averse people invest in fixed income. So we'll have more clarity, Joydeep, when you present, and in case we have more questions, I will ask.
Sure, I will address
ahead,
this
please.
right now.
Yeah.
So fixed income investments is not zero risk,
Yeah.
but the risk is relatively lower in fixed income. Now, talking of risk, there are multiple aspects to it. If you count, there would be, like, say, 10 types, 10 varieties, 10 aspects of risk. The major ones, one is the volatility, the market movement. So that volatility is obviously higher in equities than in fixed income. So that way, fixed income is relatively less volatile. So if you look at products like, say, contractual return avenues, like, say, a bank deposit or a small savings deposit, these are actually contractual. People say guaranteed, but anyway, it's actually contractual. So there is no volatility at all. If you invest in debt mutual funds, or if you invest in bonds and you sell before maturity, yes, there is a mark-to-market element there. But as I said, the risk is lower. The other aspect is the default risk. So in equity, there is no default risk. In debt, yes, default risk is there. But if you look at a long history, and if you forget the some of the stray incidents like say ILFS or DHFL, then broadly, yes, default risk is there, but it is not as pervasive. Even after those whatever incidents, events happened in the past, that has given decent returns. And also on the volatility, I'll just make one clarity here for the benefit of participants. Market correction happens in any market, be it equity, be it bond, be it gold, be it currency, be it any markets. Now, there is a difference in the nature of correction and recovery in equity and bond. In equity market, when the market corrects, it is only an expectation or a probability that the market will correct, market has bottomed and the market will go up from now on. Whereas in bond, what happens is when yields are moving up, prices are coming down, that higher yield is actually there. So to give you an example, let us say there is a debt mutual fund scheme and the portfolio item is say 6% as an example. RBI hikes rate, that 6% becomes 7%. So as an impact, the mark-to-market impact, so as and when yields are moving up, prices are coming down.
Yeah.
So the NFV of the debt mutual fund is getting impacted. But the point is that higher yield is there in the fund itself. It is not visible. But in the background, that 6% has moved up to 7%. So you just be in the fund, you remain invested for whatever, another 1 year or 2 years, 3 years, and you get the benefit of the higher accrual. And how does that happen? The maturity value remains safe. To give an example, let us say maturity is rupees 100, the face value is rupees 100, and YTM is 6%. When 6% moves up to 7%, my valuation yield comes down, 99, 90, 97, whatever that number is. Yeah. But on a maturity, when the bond matures, I get rupees 100 back, irrespective of the valuation level of 101, 102, or 99, 98, it is rupees 100, the face value that come back to me. Which is why in a bond, even when there is a correction in the market movement, it is there in the background. Maybe it's not as visible at that point of time. Yeah, so let me start sharing my PPT.
Yes, Joydeep, I'll be in the background, muted. In case you require me, please.
Yeah, sure. So anything happen, you can just interrupt me and talk. Yeah. So this is the topic for the day, interest rate movement and impact on debt funds. And this is the agenda. How the market discounts the likely raises in interest rates in India and globally. So I'll discuss that. Globally, inflation is a big concern and globally interest rates are going up. Then we come to how debt funds value their fixed income portfolios, the mark-to-market company which I just discussed. The concept of hold to maturity, and there's some confusion in hold to maturity between bonds and hold to maturity of debt funds. So I will come to that in some time. And the intra-asset allocation, which people ask me nowadays, that in debt, what to do, where to invest. So I will start off with my first thing, interest rate scenario. So today what is happening is inflation is a big concern globally. And why is inflation high? Obviously, recovery. So we had pandemic, we had slowdown. And when we had the recovery from the pandemic induced slowdown, obviously inflation had to go up. But what has happened thereafter is the Russia-Ukraine war. So there is one stated war, which is the Russia-Ukraine war. And there is one unstated war, which is for the control of resources globally. So if you look at it globally, everything, crude oil, metals, fertilizers, anything which has some relation with Russia or Ukraine or some other part of the world, prices are going up. So inflation is a global concern. So globally, central banks are hiking interest rates to fight inflation. So I will just show you some data on this thing from certain countries, certain leading major countries. Firstly, US, because that's supposed to be the bellwether. US is like whatever. So in the USA, we have something which we colloquially refer to as dot plot. The official name is SEP. You can see the screen, SEP. SEP stands for Summary of Economic Projections. Now, what is this thing? The members of the US Fed FOMC, there are 80 members for doing this thing, the regional Fed governors. They put a dot as to where they see the Fed rate, maybe 1 year down the line or 2 years down the line, or maybe say 3 months, 6 months down the line. So what it means is, one is, if I may put it in a very, what should I say, colloquial word, gyanbaji, my view, my this, my that, and all those things. They will do that also. But apart from that, in a very objective manner, all said and done, where do I see the US Fed rate 3 months, 6 months, 1 year, 2 years down the line? And they publish this in every alternate US Fed FOMC meeting. FOMC as in Federal Open Market Committee. So in the latest meeting, 15th of June, this is the dot plot. Doesn't make much sense to you because if you're seeing for the first time, you just see some dots. The sense of this is, as per this, the median forecast of the US Fed members of the US Fed rate is 3.4% by end of 22. As of today, it is 1.5 to 1.75%. That will become like 3/4, 3/2, 1 year from now, which means the Fed members are talking of a steep rate hike. At least they're talking about it because there are concerns about recession in the USA. So whether they will be able, be not able, that's a question. But yes, as of now, they are sounding brave and they are saying, yes, we will hike rates aggressively. They have hiked 1.5, 1.75 is the range as of now, and they will continue hiking in the US. And how has the US Treasury market moved? So in the pandemic phase, the US Treasury 10-year touched a low of only 0.5%. That was in August 2020. So from those levels of only 0.5% August 2020, sometime earlier, maybe 2-3 weeks earlier, US 10-year touched a level of almost 3.5%. It's a big move. The market discounted all these things, possibility of Fed rate high inflation and whatnot. Now it is like approximately 3% or little less than like 2.95, sub 3% as of now. So as you can see from in the graph, this is a 20-year, 22-year graph. So from the high levels, it was like a high of almost 7% on the left-hand side of my graph. Around 7% came down to, like, if you can see my cursor, around 0.5% in August 2020. That's like approximately 3%. So this move from 0.5, you can see the cursor, to 3% is discounting of potential future rate hikes in the USA. Coming to Eurozone, so there is no one this thing. So we take Germany as the representative. They call it Bund, B-U-N-D, in Germany. So there also, as you can see, from the very low levels of the pandemic period towards the right side of the graph, it has moved up. This is a long period graph from Jan 2000, so 22-year graph. The low was negative 0.86 in March 2020 in the pandemic period. So from negative 0.86 up to around 1%, positive 1% now. This also is a big move. But the point is, the Eurozone, the ECB, that is European Central Bank, they are yet to start hiking rates. Possible, yes. People are saying July. They also have said likely July they will start hiking their rates. But even before they have started hiking their rates, market has reacted, as you see, minus 0.86 to approximately 1%, represented by the German Bund. Now, globally, while everybody is hiking rates, there are two exceptions. The first major one is China. China is actually reducing rates because their situation is bad. And to an extent, even Japan. So Japan won't hike as of now. They're like static for some time. But China, they're actually reducing. So we talk of China as high growth engine and whatnot. But yes, they are in bad shape and they are actually reducing rates to support their economy. So basically, apart from China and Japan, the entire world is hiking rates. Now we come to our India. So what's happening in India? As of now, inflation is the biggest concern. So the graph you see, this is the CPI inflation data from 2012, the current series of data. So if you see the high point here, it is much on the higher side. It was 11.5%. That happened in 2013. So from those levels, it came down here. It touched a low of only 1.5% in 2017, and now it has moved up here. It touched a high of 7.7, and now it's down to 7.04%. Now, why is inflation such a big concern now? Because subsequent 2014 onwards, RBI has been what is called FIT as in flexible inflation targeting. So what does it mean? 4% central target, so 4% plus minus 2 on either side. So 2% lower band, 6% upper band. That is the flexible target which RBI has. Now, as long as inflation is more than 6%, it is higher than the tolerance band of the RBI. And the understanding, the arrangement is, if inflation breaches 6%, the upper tolerance band, for 3 consecutive quarters, the RBI is answerable to the Parliament of India. And that is very likely to happen. Quarter Jan-March this year, it was more than 6. This quarter, April, May, June, you know it, you know the numbers. Likely that next quarter also, July, August, September, it will be more than 6%. So RBI will do that. They will give the resignation to the Parliament of India that we have changed stance, we have done whatever, we have hiked rates, and the government has taken measures like reduction of excise duty and export duty and all those things, but those formalities will happen. So inflation is the big concern in India now. So this is the RBI projection. So if you look at it, 3 consecutive RBI MPC policy review meetings. 10th February, their forecast was only 4.5 for FY23. So all this is FY23. For FY23 on 10th Feb 22, they forecasted only 4.5% when the entire market was north of 5%. The market was saying like 5, 5.5. I don't know why RBI forecasted only 4.5. So between 10th Feb and 8th April, what happened? The war broke out. So war broke out, all this crude, metal, fertilizer, and all these prices went up. So on 8th April, RBI revised it upward to 5.7%, both FY23 from 4.5 to 5.7. And then the latest one on 8th of June, they hiked it again from 5.7 to 6.7%. So now RBI is saying that FY23 inflation will be as high as 6.7%, which means they are accepting it will be higher than their tolerance band of 6%. And what's the breakup as per RBI? So they are saying first quarter, which is April, May, June, this April, May, June, 7.5. Next quarter, July, September, 7.4. Then quarter after that, which is October, December, 6.2. And only in the last quarter, which is Q4, that is Jan, March 23, it will come down to less than 6%. So this is the background. This is the reason RBI has already hiked rates, repo rate hiked by 90 basis points, and likely that they will hike going further also. There are forthcoming meetings. 27th July, we have the meeting of the US Fed FOMC where they will hike rates. We have the meeting of our RBI MPC, Monetary Policy Committee, on 4th of August. There also likely they will hike rates, basically due to inflation concerns. So this is the history of repo rate, long period history, 20-year history, 21-year history. So if you look at it towards the right-hand side where I'm pointing the cursor, here the repo rate is the lowest ever. Now, what does this represent? This represents the pandemic period when the entire country was slowing down. Everybody was doing their bit to do whatever they could, medical staff and others. So RBI infused liquidity and reduced interest rates for pumping, for helping the economy. So this was the lowest level ever. And from here, 4%, now it is 4.9%, and likely that it will be hiked further from these levels. So this is, I'm presenting one metric here. This is the spread between the 10-year government security yield and the repo rate of that day. So over a long period of 21 years, the average spread is 1%, approximately 1.05. So approximately 1% is the spread. Whereas today, when repo rate is 4.9% and 10-year is say 7.4%, it is 2.5%. It's much on the higher side. So what it means is the market has already discounted RBI rate hikes going forward. And that's how the market has reacted. So if you recall, on 3rd of May, 10-year benchmark yield was around 7.1%. And why 3rd of May? Because you will recall on 4th of May, RBI did that surprise out-of-turn rate hike. 4th of May, there was no scheduled meeting. Suddenly, the governor came and announced the rate hike. So on 3rd of May, it was around 7.1. Today, it is around 7.4. So only 30 basis uptick in 10-year G-Sec yield. Whereas RBI has hiked rates by 90 basis points, 40 basis on 4th of May and 8th of June, 50 basis, 90 basis points. So as against 90 basis point of hike by the RBI, 10-year G-Sec yield has moved up by only 30 basis points. Why? Because the market had already positioned itself. The market knew that rate hikes aane wala hai. So what it means going forward is, since it is mostly in the price, as and when RBI hikes rates, today it is 4.9, going forward it will be whatever, 5.5, 5.75, 6, whatever as per RBI's call. Market will react, as in yield levels will move up, but yield levels will move up less than commensurate. In the sense, yield levels will not move up as much as the RBI rate hike. To give a very simplistic example, if RBI hike is say 1% from these levels onwards, it will move up by whatever, 30, 40, 50 basis point. I mean, anybody's call, but much less than 1%. As an example, this is illustration I'm giving you. So that's the background. Just summarize the background. Globally, inflation is a concern. In India, also inflation is a concern. Globally, interest rates are being hiked by central banks all over the world, except China and to an extent Japan. RBI also, they are hiking rates, which is temporarily adverse for debt mutual fund, because as and when interest rates are moving up and yield levels are moving up, yield and price move inversely. So bond prices are coming down. So in debt mutual funds, that NAV valuation, the valuation yield is moving up, valuation price is coming down. So the impact on the NAV as of today is obviously negative. So before we come to that, I will just quickly cover some basic concepts of debt. So one is this concept of maturity. So in a bond or a bond fund, the word maturity is same as the English word maturity. There is no complication there. But the word duration has a different meaning in bonds. So what is the utility? There is something called modified duration. So this modified duration in the market, we call it the multiplier, in the sense, whatever is the extent of movement of yields or interest rates in the secondary market, what is the consequent impact on the price of a bond? That is given by modified duration. That is why we call it multiplier. As an example, if the modified duration of a bond is 5 years, then approximately 5 is the multiplier. So if yield comes down by 1%, so yield and price move inversely. If yield comes down by 1%, price moves up how much? By that into 5. 5 is the multiplier. So the price was 100 earlier, now it becomes 105, and vice versa. If yield moves up by 1%, price becomes 95. So debt mutual funds holding bonds or any other instrument, that is how the valuation for NAV will happen, which is why the impact is adverse. And to explain the concept of duration in simple language, duration apart from zero coupon bonds is less than the maturity of the bond because there is some cash flow coming prior to maturity. So very loosely, the concept of duration is the effective weighted period I have to wait for getting my cash flows back. So the example I'm showing you here, consider one bond with a face value of rupees 100, coupon rate 8%, maturity 7 years. So this bond is effectively a contract between the issuer of the bond and the investor in the bond, that you pay me rupees 100 today, and I will pay you rupees 156 over a period of 7 years. In what manner? The issuer will pay rupees 8 after 1 year, rupees 8 after another 1 year, and so on. And only for the last terminal cash flow, I have to wait for 7 years. Which means since I'm getting some cash flow prior to maturity, my effective weighted average period for getting my cash flows back, my money back, is not 7 years, but less than 7 years. That very loosely is the concept of duration. So like I showed you earlier, if 5 is the modified duration, 5 is the multiplier, that gives a sense of what is the level of volatility in a fund. So like in a debt mutual fund portfolio, when you see these metrics like portfolio whitening so much, portfolio Macaulay duration so much, modified duration so much. So that modified duration is the multiplier. So as we just discussed, this measures the sensitivity of the bond, as in sensitivity to market movements. So if you buy a bond directly, if you hold till maturity, there is no sensitivity. The entire movement prior to maturity is only academic. If you buy a mutual fund, as long as you're holding it, as long as the market moves, yes, there is a impact. So if impact is favorable, movement is favorable. If yield comes down, price goes up, good for you. If yield moves up, it is temporarily bad for you. So this shows the extent of variability. For the same market movement, so yield movement of whatever, 10 basis, 20 basis, 1%. So here, same pendulum, the movement is only so much here. And here the movement is so much. Which means for the same extent of market movement, the impact on a long maturity bond fund is so much, and the impact on a short maturity bond fund is only so much. So the extent of impact is different. So accordingly, you can take your decision. You want to be in a short bond fund or you want to be in a long bond fund. Now we come to the debt fund categories. So SEBI has delineated 16 debt fund categories. The circular came in October 2017, got implemented in like say April, June 2018. So as per that SEBI circular, that SEBI norm, there are 16 debt fund categories. It starts with overnight maturity of 1 day, then liquid maturity of less than 3 months. Then we have ultra short portfolio Macaulay duration of 3 to 6 months. We have low duration 6 to 12 months, which are all graded as per the portfolio maturity. Overnight 1 day, liquid less than 3 months, ultra short 3 to 6 months, then low duration 6 to 12, then money market up to 1 year, short duration 1 to 3 years. So it's going in a graded manner as per the portfolio maturity. Then we have medium duration, medium to long 4 to 7. Now in this category called long duration, the Macaulay duration always has to be more than 7 years. But in this category, in the entire industry, only 2 AMCs have a fund because the volatility will always be high, because the fund manager, even if the fund manager has a bearish view that yields will move up, he or she cannot reduce portfolio maturity beyond a point. If macro duration is 7 years, portfolio maturity is much higher than 7 years. Dynamic bond investment across durations, as per the fund manager's call. Portfolio maturity of 4 years, 10 years, 5 years, 15 years, 2 years, whatever, as per the fund manager's call. Then we have corporate bond funds, 80% or more in high rated assets, which is AAA and AA plus rated instruments. We have credit risk funds where 65% or more in papers rated AA and below. So for this purpose, AA plus also is clubbed with AAA, only for this purpose of corporate bond fund and credit risk fund. So for credit risk fund, the norm is 65% or more in papers rated AA and below. Then we have banking PSU fund, 80% or more in papers issued by banks and PSUs. Yield fund, simple, 80% or more in government securities across maturity. So nothing about the maturity, whatever, high maturity, low maturity, as per the fund manager's call. There is one variety called gilt fund with 10-year constant duration. So portfolio maturity is around 10 years in that fund. And last one, floater fund, where 65% or more of the fund is in floating rate instruments. Okay. So next topic is mark to market. So why talk of this mark to market? In any mutual fund, the NAV that is given out, that has to be as per the prevailing market level. So there's no debate about that. The debate is elsewhere. Let's say in an equity mutual fund, these shares are traded. So whatever is the closing price, that closing price is taken and used for valuation of NAV. So there is no issue there. The issue in debt is, one is the market is not very liquid. Beyond G-Secs and beyond AAA, the market is not very liquid. And even within that, let's say a AAA security, which is fairly liquid, what is held in the portfolio of a debt mutual fund is a particular ISIN, not just any paper issued by the issuer. And that particular ISIN may not be traded so frequently. So the issue is, I hold a particular paper in the portfolio, a particular ISIN. If the last trade happened, whatever, 1 week ago, 2 weeks ago, 3 weeks ago, what is the level I take for my valuation? So as per implicit regulation, there are 2 designated agencies, which is CRISIL and ICRA. They do the valuation every day, as in every working day, as per the estimate of market level, and they give out the valuation yield level that is converted to price, and that is how the NAV is valued. Now, how do debt funds work? In any debt fund, returns come from 2 sources. One is the accrual. So accrual is, so there is a coupon in any debt instrument, be it a bond, be it a, even if it is a discounted instrument like CD or a CP kind of instrument, there is no stated coupon, but yes, there is an equivalent, conceptual equivalent of coupon. So there is a return in every debt instrument. So that accrual does not go anywhere. That is there any which way. And there is a NAV movement every day, depending on the market movement. Yields going up and down, market prices going up and down. So if the market price of a bond is going up, it adds to the NAV of that day. If the market price is coming down, that takes away from the NAV of that day. So market movement happens every day. The accrual is given. There is no debate about it. But when you see muted returns in debt funds, that means at that point of time, in that period of time, yield levels are going up, price levels are coming down. So that is taking away from the accrual for that period of time. And if the market movement is severe, I think very steep upward movement of yields in a very short period of time, that takes away a lot from the accrual. So it takes that much more time for accrual to catch up. Now to explain to you how this concept of accrual and mark-to-market works. So one simplistic example, let's say there is a bucket under a tap getting filled with water. So we can calculate that this is the size of the bucket, this is the speed of the tap water, so much water is flowing and how much time it will take to fill up and all that. But there is a variable. It may so happen that suddenly a mug of water is taken away from the bucket. What is that? When yield levels move up, price levels come down. That adverse mark-to-market is taking away from the accrual. So a mug of water is taken away. So it will take that much more time for the accrual to catch up. So the tap water is flowing, that does not change. But a mug of water being taken away means it will take that much more time, and vice versa. If yield levels come down, suddenly a mug of water is added to the bucket. It takes that much less time for it to fill up. So the accrual is there, only that depending on market movement, a mug of water is added or taken away. So that mug of water is that mark to market can be adverse, can be favorable, and the accrual is tap water. That accrual does not go anywhere, that remains there. So in the entire period, so like last 1 or 2 years when yield levels have been moving up, discounting RBI rate hikes, what was happening is the accrual level is moving, but the market movement being adverse, prices coming down. That mug of water is being taken away, not added, which is why as of today, you will see debt fund returns as muted. So valuation, as I just said, it is given to designated agency, which is CRISIL and ICRA. They give the valuation every working day for each and every security, for each and every ISI. And that is used by the mutual fund industry and taken for valuation. Now we come to the concept of hold to maturity. Hold to maturity as such is a simple concept. You buy a security and you hold it till maturity. So if it is a bond, if it is a 5-year maturity bond, you buy it today and you hold it for 5 years. It is simple hold to maturity. If you sell it before 5 years, it is you are not holding it to maturity. So the sale yield or sell price level at the point of sale depends on the market at that point of time. So if you sell after say 2 years, 3 years, 4 years, whatever, depending on the market movement at that point of time, you may get a favorable price, you may get a not so favorable price. But if you hold till maturity, what it means is you are insulating yourself from market movements. So after 5 years, interest rates go up, come down, does not matter. After 5 years, the price of similar bonds have gone up, come down, does not matter. Whatever is the face value, you will get that on maturity. So there are certain contractual products like we discussed earlier. It's a bank term deposit, post office savings deposit, or corporate deposit. It's a defined maturity. There are bonds with a defined maturity, which you can hold till that designated date. Now, in mutual funds, is it possible to hold to maturity? So that depends. So earlier days, we had FMPs with a defined maturity date. If it's a 3-year FMP, after 3 years, it will mature, the product matures, and you get your money back. So it is possible to hold an FMP, a fixed maturity plan, till maturity. Nowadays, FMPs have faded away, and now we have target maturity funds, TMFs. So TMFs have defined maturity dates, the entire range from 3 to 10 years, 3 years, 4 years, 5 years, 6 years, the entire range from 3 to 10 years. There is some product floated by multiple AMCs. So as per your cash flow requirement, you can pick and choose your fund and target maturity fund, and you can hold it till maturity because there is a defined maturity date. Simply means the product matures, paisa vapas. Now, in case of other products, so just to go through this text, a bond has a defined maturity except perpetual bonds. On the designated date, the money flows back. Target maturity funds and FMPs, they have a defined this thing. But the confusion which happens is in case of the usual regular normal debt mutual funds. People confuse the portfolio maturity with the maturity of the fund. So as an example, if it is a short duration fund, as of today, if it has a 3-year portfolio maturity, it does not mean that after 3 years, the fund will mature. If the fund is there today, the usual regular normal open-ended fund, after 3 years also, the fund will be there. After 10 years also, the fund will be there. Whereas if it is a 3-year FMP or if it is a target maturity fund, after 3 years, the fund matures and money comes back to you. Whereas in a usual open-ended fund, that 3-year in a short duration fund or a banking PSU fund is the portfolio maturity as of today. So after 3 years, also it will have a portfolio maturity, depending on the fund manager's call and market strategy and all those things, maybe around 3 years, 2.5 years, 3.5 years, whatever. Some portfolio maturity will be there after 3 years also. So which means in a usual debt mutual fund, you can hold for a tenure, which is equivalent to today's portfolio maturity. So today, if it is a GSEC fund with 10-year portfolio maturity, yes, you can have a horizon of 10 years. Today, if it is a money market fund with 1 year maturity, yes, you can be into it for 1 year, or if it is a short duration fund, banking, PSU, corporate bond fund, 4 year maturity, you can buy it and be there for 4 years. But there's a conceptual difference. You are not holding it till maturity because an open-ended fund does not, or is not supposed to mature at least. So that was the background. So what do you do now? So you must be seeing for quite some time the commentary in media, social media, various platforms. The advice is that in a volatile period, when interest rates are going up, RBI is likely to hike rates, you should reduce your volatility and be in shorter maturity fund. Why? Like I showed you that sensitivity, that pendulum. For the same market movement, the extent of volatility at the longer maturity is higher, at shorter maturity is lower. So if it is, let's say, a gilt fund with a portfolio maturity of 10 years and a modified duration of, say, 6 years, volatility is 6 times. If it is, say, a short duration fund with maturity of, say, 3 years and portfolio duration of, say, 2.75, then the multiplier is 2.75. So if interest rate goes up, RBI hikes rates, the market reacts, or market reacts even before RBI rate hikes. The multiplier being 6, the impact on the GSEC fund will be as much, whereas in the short duration fund, the impact is only so much, 2.75 is the multiplier. Or if it's a liquid fund with 2-month maturity, the impact is only so much, like 2 by 12. So 1 by 6 is the impact of that market volatility, that much lower. So the commentary which you must have seen, the advice that in a volatile time, you be in a short maturity, short duration product, yes, that view is correct. But I want to give you one more nuance to it. Yes, to reduce the impact of volatility, you be in a short maturity, short duration product, but there is a cost of waiting also, which people tend to miss out. So I'll give you one illustration of this. What is this cost of waiting? Let's say you have an option of a liquid fund with a portfolio account of 3.5. So now it is higher than 3.5, but take as an example, let's say it is only 3.5. Portfolio maturity is low, and for simplicity, we take it as zero impact of market movement. And there is one conventional debt fund with a portfolio accrual of 6%, maturity of 4.5 years, and a modified duration of 3 years. So 3 is the multiplier in this normal usual debt fund. Assumption: interest rates move up next 6 months by 50 basis point or 0.5%, just assumption, because nobody knows actual market movement. And your horizon is 1 year. So what is the usual approach? The usual approach is, since interest rates will move up for 6 months, remain safe, low volatility in the liquid fund. So for the first 6 months, you be in the liquid fund. And then after the market has adjusted, you move into the other normal usual bond fund. You shift, which is okay. There is nothing wrong with that. But what is the cost of waiting? In the first option, the liquid fund for 6 months, I get an accrual of this much, 3.5 per rupees 100. And in the 6 months, yield levels have moved up. So in the other usual bond fund, that 6% accrual becomes 6.5% after 6 months. And over the next 6 months, my accrual in the other fund, the bond fund, is 6.5 by 2, since it is 6 months only, 3.25%. So in the liquid fund, I earn half of 3.5, it is 1.75, and half of 6.5 is 3.25, so I earn rupees 5 per rupees 100. What is the other option? If I decide not to wait, volatility, whatever happens, I'm okay with that. Sidha bond fund mein laga do. Intuitively, you will think I will lose a lot because the maturity is higher, duration is higher, multiplier is higher. So as and when yields are moving up, I will have an adverse consequence. So over the first 6 months, the accrual is 6 by 2, which is 3 rupees. But there's an adverse mark-to-market impact. The duration is 3. So net of this adverse mark-to-market impact, so 3 minus 1.5, only 1.5 is my accrual. And next 6 months, it is moved up. 6 is now 6.5. So half of that is 3/4. So overall return for 1 year in this option is 4.75. So my point here is, if you do the weighting out and all that, you get 5%. And if you do this investment straight away in a bond fund, in spite of the volatility, you earn 4.75. Yes, 4.75 is lower than 5, but only so much. Intuitively, it would seem like, oh, if I go straight away in a bond fund, I would lose so much, market is so volatile, and all these things. That is my first point. And then my next point is, this is the crux of it. If it is a fund with a portfolio maturity of 4 or 5 years, duration of whatever, approx 3 years, your investment horizon should be 4 years approximately. And if you hold for even 3 years, how much do you earn? Assuming there is no further market movement. So 4.75 plus 6.5 plus 6.5, which means you earn a decent return of almost 6% in this fund, in spite of the initial volatility. So net, what you will do now, as I said, yes, RBI will hike rates further. Yes, market will react further, as in 10-year yield will move up, shorter end yields also will move up, but only so much, because most of it is already in the price. So if you have a long enough horizon, and what is long enough horizon? So there is nothing hard and fast. The ballpark is to be in the fund. So what is today's portfolio maturity? Like I said earlier, the data on today's portfolio maturity is 3 years, 4 years, 5 years. Accordingly, you can decide, and accordingly, you can set your investment horizon. So if it is a banking PSU fund of, say, 4-year maturity, or a corporate bond fund of, say, 4-year maturity, you come to the fund with a horizon of, say, 4 years. If it's a gilt fund of, say, 10-15-year maturity, you come with a very long horizon, like 10-15 years. So there is this concept of laddering. Now, if you go to these big US books and that, they will call it portfolio immunization, but the concept is simple: laddering. So when laddering, you match your cash flow. In financial planning, you match your cash flows with the investment. So in equity, there is no maturity, so you can't do laddering. You can only have an adequately long horizon of whatever, 10 years or something. In bond, if you buy bonds directly, you can do laddering. You can buy bonds of 2 years, 3 years, 5 years maturity. If you buy target maturity funds, yes, you can buy TMFs of commensurate maturity, like 3, 4, 5, 6 years. In an open-ended usual bond fund, there is no maturity of the fund as such. But yes, as long as you're there for an adequate horizon, like if the portfolio maturity today is, say, 3 years, you can come in with a horizon of 3 years. That should be adequate. Adequate means to tide over market cycles. So we have already discussed this. So as of now, after portfolio yields have moved up, like I said earlier, over the last couple of years, while yield levels have moved up and the mark-to-market impact has been adverse, which is why today you see neutral returns in bond funds, the portfolio yield also has moved up, and the benefit will come to you over a period of time. Just as an example, today there's a target maturity fund with a maturity of 5 years, and expense ratio is very low. So I have taken the YTM itself as the net of expense YTM. And so this is the crux, whatever is the inflation level over the next 5 years. So if I assume 5%, it can be anything. If I assume 5% over a holding period of more than 3 years with the benefit of indexation, the 7.4 translates to almost 7% return. So today, if you have a horizon of 5 years and you buy into a target maturity fund with a 5-year horizon, where the portfolio yield net of expenses is around 7.4%, depending on the indexation level given by the government, you will get approximately 7% return, which is good. Another example I'll show you, this thing called tax-free bond. So there is no fresh issuance now. It used to be issued earlier. So we have the earlier outstanding stock in the market. So these bonds can be purchased in the secondary market. So if the yield is, say, 5.4%, for comparison purposes, for comparing with other bonds which are taxable at your slab rate is 30% plus surcharge and cess, and it is not just the tax rate but surcharge also, which varies as per your tax slab. So in the tax slab of this less than 50 lakh, there is no surcharge, there is cess 4%. In this tax slab, sorry, income slab of 50 lakhs to 1 year, this is, I think, 10% surcharge is there. So surcharge and cess of kuch pakad ke, your tax rate is this one, 34.32%. At the highest tax bracket, for a person earning more than rupees 5 crore in one financial year, 37% surcharge, so net, the tax rate is 42.74%. Which means if I buy another taxable bond on that, I have to pay tax at this rate, 31.2 or 34.3 or 35.8%. So if I have to compare a tax-free bond yield, if it is, say, 5.4%, the comparable level is as high as this, 7.85, 8.22, 8.4. Now, not to be confused with the previous example, what I showed you earlier, this is over a 3-year horizon in mutual fund. So mind you, in bonds, debentures, there is no indexation. Indexation is there only in mutual funds. So if you have a 3-year horizon, it becomes tax efficient. So this calculation and this calculation is not to be confused. So this can be compared with bank FD, where you pay tax at your marginal slab rate, with another bond which is taxable, or debt mutual fund for a horizon of less than 3 years, because less than 3 years there is no indexation. So with that you can do this comparison of tax-free bonds. Just two examples of target maturity fund and tax-free bonds. So this gives you the overview. Conventional bond, if you get so good quality AAA, if you get say 7.5% yield, depending on your tax rate, 35.88 in this bracket of 1 to 2 crore, you get, to move this, 4.8 net of tax. If you get a tax-free AAA PSA, which is a good quality, you get 5.4 because anyway this coupon is free of tax. Bank perpetual bonds. So yes, rates are somewhat higher, net of tax around 5-ish thing, and there's a product called market linked debenture, which is tax efficient and put to tax as capital gain. So with that, I think, Pushkar, I will minimize my PPT and have an open discussion with friends.
Thank you, Joydeep. You can minimize. Yeah, okay. So Joydeep, as you explained in the presentation, we don't have to really bother about interest rate movements in case we are invested for the long term.
Yes. So just to reiterate the logic as to why we are saying we don't have to bother. One is the accrual is always there. Rather, today's accrual is in fact higher than it was say 1 year or 2 years ago. It is that much better. And even if there's a further this thing, like further rate hike by the RBI and the market reacts further, yes, that adverse impact can happen, but the accrual level will be that much better from these levels onwards. So what it means is, let us say 1 year from now, RBI is done with rate hikes, things will stabilize. So if you are there in the fund for another 1 year or another 2 years, you get the benefit of the higher accrual in the fund. So just be there in the fund. So over a long period of time, you have the accruals and market cycles also even out. So that is the this thing. Just to give you one example, gilt funds are the most volatile. Now people think gilt fund there is no credit risk. Yes, there is no credit risk, but gilt funds are most volatile because the portfolio maturity of gilt funds is the highest. It's the longest, and so it is most volatile. But over a long period of time, gilt funds have outperformed other debt funds, which are less volatile. And in spite of a better portfolio quality and high volatility, gilt funds have done well. So come to the fund with the appropriate horizon, investment horizon, and you don't have to worry.
So Joydeep, it's a crude balancing act between accrual and mark to market. You have to balance that.
Yes.
And Joydeep, when everything is coming down, gold is stable, I think interest rates are moving up. So of course, we have a better opportunity in accrual when we say fixed deposits or other bonds which are coming at a higher rate now. But still, it's a crazy scenario when we don't know the people you are putting your money in, like some bond funds. The credit risk is higher in this scenario. When the interest rates move up, the projects may not fructify the way you think. So there's higher risk in debt markets also.
So as I said, in the debt market, risk is there, but my take is the credit risk is actually lower than earlier. And how do I say so? On what basis do I say this thing? So rating agencies, CRISIL, ICRA Care, they publish a metric called upgrade downgrade ratio. Okay. And the upgrade downgrade ratio has actually improved. In fact, if you track the pandemic period, while the economy was downbeat, all things were in doldrums and all those things, in the pandemic period, corporates did a very good job of managing themselves in terms of top line, bottom line, margins, and all these things. And today, with a better upgrade downgrade ratio of rating agencies, things are actually improving. And also, if you look at it, the worst default cycle, the worst ever default cycle in the debt market history of India, that started with ILFS in September 2018 and went on till Yes Bank 81 till February, March 2020. So after that, there is no major default, maybe 1 or 2 cases here and there, like future retail and all that. So that way also, I would say that credit risk is actually diminished than earlier. And as I said, with yield levels going up, accrual level is actually better than earlier, which is good. That suits investor that much better. Okay, there's a question.
Yeah, there's a question like, can you throw some light on the current debt scheme yields?
So I don't have the data offhand. So you can, there are various websites which are there where you can track. The reason is I don't want to highlight or push any particular fund or something. Just to give you an example, if today 10-year GSEC is say 7.4%, let's say 3-year GSEC yield is say around 6.97% kind of level, and if 3-year AAA bond is say around 7.5% kind of level, that gives you a ballpark idea what the yield level of debt mutual funds will be. So only thing you have to consider is if say 7.5 is the yield level in a debt mutual fund, that is pre-expense. So your return will be YTM minus expenses, and of course plus minus the market movement. So if say 50 basis is the expense ratio and if 7 is the YTM, so 7 is the net accrual level plus minus the market movement. Or if expense is say 1%, so it becomes 7.5 minus 1, like 6.5%.
I think there's a question, when the yields rise, do the coupons paid by bonds, they also rise?
I think that's an interesting question. I'll give the answer. Yes. Or coupons do not change till the maturity of the bond. Yeah. So that's good for clarity of all participants. So a coupon of a bond once fixed does not change. The only exception is floating rate bonds. So how a floating rate bond is defined is there's a benchmark. There's a defined benchmark. So let's say if the benchmark is MIBOR, and if the term of the bond says MIBOR only, so it is MIBOR. If it says MIBOR plus 1%, it's MIBOR plus 1% as per whatever the terms of the bond will define. Now, in the Indian context, in the corporate bond, 95% or more is the usual variety fixed coupon bond. Floating rate bond is less than 5%. Government bond, yes, little higher percentage is there in floating coupon government bonds. So apart from floating rate bonds, in a normal usual bond, the coupon rate does not change. So then how does it help you? So it helps you in two ways. One is, let us say you invested in a debt mutual fund 1 year ago, and over this 1 year, yield levels have moved up, prices have come down. So as an example, if the face value is 100, as and when the yield level is moving up and price is coming down, today for NFE purposes, the mutual fund is valuing that bond instead of 100 at say 99, 90, 97, whatever that level is. But when the bond matures, you will get 100 only, not 99, 97, 98 as per the valuation level. And the other this thing that happens is fresh investment. So this bond matures or the fund gets fresh money. Fresh money is getting invested at the prevailing yield level of that day. Again, prevailing yield level of that day is not a function of the coupon rate. So as an example, if the coupon rate of a bond is 6% and if the negotiated yield for purchase is 8%, it means the price will be consequently lower, so that even if the coupon is 6%, your effective return is 8%. Effective annualized CAGR return is 8%.
So Joydeep, it's good to remain invested in debt funds. Of course. There's no panic in case the interest rates are rising, because the mutual funds are doing that. They are maturing the bonds and they're investing at lower valuations, which gives higher yield.
Yes.
Yeah.
And there's one more question here. Gilt funds are safe, aren't they? Because they invest in government purpose. See, what is important here is to bifurcate between two risks. One is credit risk and one is volatility risk. As I said earlier, in a government security fund, gilt fund, the portfolio maturity is actually the highest, and the sensitivity, the interest rate volatility is actually the highest in gilt funds then as compared to other debt funds. But credit risk is not there. So let's say theoretically the risk is 0. So there is no credit risk. But many people think because it is government security, there is no risk at all. No, there is no credit risk. But market risk, volatility risk is very much there. So what is required is you have to come into the fund with an adequate horizon. So as an example, if the portfolio maturity of the fund is say 10 years, as an example, you should come into the fund with a horizon of 10 years. So in the interim, everything will happen. In the interim, yield levels will move up, come down, and over a period of time, things even out, things settle down, and you get the accrual for 10 years. So then over an adequate holding period, you are safe from market movement, and credit risk is anyways not there. So horizon is important.
So Joydeep, when will the next opportunity emerge? Especially in 10, when will the next opportunity emerge? Because when the interest rate peak out, maybe in 1 year, 1.5 years, this is a great opportunity in government securities funds.
So I think you're asking about the timing as to when we expect yield levels to peak out. Is that the question?
Yes, exactly.
Yeah,
So
yeah.
we should wait out for about 1.5 years to enter into gilt funds.
Now I'll give you the answer.
Yeah.
My sense is less than 1.5 years. I'll give you the logic
Okay.
also. So as I said earlier, the market has already mostly discounted. So like I said earlier, the average spread over the last 20 years between 10-year government security and RBI repo is 1%. Today it is 2.5%, which means the market has already mostly reacted.
Yes.
Little bit still there. Okay, from today 740 it may go up to whatever, 7.5, 775, 8. That's anybody's call. Little bit of it's maybe still left. But yes, the market has mostly discounted. On the timing bit, so first of all, my first point is that the market, any market, be it equity, be it bond, be it gold, forex, any market does not wait for the actual event to happen. The market reacts before that. That has already happened. The next point is, since the RBI rate hikes are already almost priced in, what remains? So the only thing that remains to be priced in is what the market is saying, that there may be excess fiscal deficit and there may be excess government borrowing. And as per market view, if that happens, excess fiscal deficit of approximately 1 lakh crore and excess government borrowing, that is likely in the last quarter of the fiscal year, which is Jan-March 23. So market experts are saying that in the quarter Jan-March 23, the government or the market will get a sense what is the additional fiscal deficit and additional borrowing. Now, the market discounting of that will happen like, say, December, January, February. Market will get a sense of whether there is an excess borrowing or not. So maybe around that time, December, January, February, whatever that level is, I think around that time, it will peak out. Whereas RBI may hike later also. RBI may hike in April also. But by around December, January, February, the market will be mostly ready for whatever is about to come.
So as you said, Joydeep, less than 1.5 years. So around this next budget time is the right opportunity to just have systematic investments in long dated gilt funds.
Yeah, in fact, there's one more reason I didn't tell you so far. Why is it around the budget time? One is obviously in the budget, you get a sense of any additional borrowing happening, not happening, and all these things. Another this thing is April 23, inflation will come down any which way. Now, how do I say this confidently? Now, because all this Russia-Ukraine war, crude oil price, so many things can happen. So how can I say this confidently? Inflation is measured year on year. This April, inflation was as high as 7.79%. That too on a favorable base. What it means is today as in April 22, when inflation is as high as 7.79%, that too on a favorable base means that inflation index is that much high, which means for April 23, the comparison, the base index is that much high, which means April 23, inflation will come down any which way.
Great. So market will discount that earlier than expected.
Yes.
So it's a great science, Joydeep. And as you said, we have to remain invested, invest systematically also in fixed income. And Joydeep, we always say that equity should be part of every portfolio. Maybe a person who is retired also may retain some 20% in equities. So what's about debt, the fixed income? How to invest systematically in fixed income portfolios?
So SIP, which way everybody, at least CFPs, know what is the funda of SIP. So let us say SWP.
Okay.
So let us say, like you said, retired person. So if somebody say 60-year-old and retiring, whatever is the appropriate allocation in the portfolio, so much to equity, so much to debt. So what is the logic that even for a retired person, he may have some allocation, 20% or whatever percent to equity. The logic is if the adequate horizon is set 10 years. So at age 60, he still has a life expectancy, whatever, 10, 20, 30 years hence. So if 10 years is the adequate horizon for equity, then yes, to that extent, he can have some allocation to equity also. The SWP can be started with debt, which are low volatile. So that equity component, whatever 20% that you keep for the longer term, even for a retired person, from the debt component, low volatility, lower maturity products, you start the SWP, and afterwards you can start the SWP from the equity also. From the tax efficiency point of view, if possible, start the SWP in debt after 3 years. You get the indexation benefit, FIFO basis, and equity of anyways it is a long duration, long horizon thing. It should start from after 1 year for the tax efficiency.
Yeah, tax efficiency has to be kept in mind while withdrawing from debt funds. Thank you, Joydeep. Thank you so much.
Sure, it was a pleasure interacting with you and the participants.
Thank you. Have a great day, Joydeep.
Thank you. Bye.